Good morning, everyone, and welcome to this morning's webinar on ESG disclosures in IPOs. First of all, let me introduce myself and the panel with you this morning. So my name is Inigo Esteve. I'm an ECM partner in the London office, and I specialize on IPOs both on the London Stock Exchange and across EMEA. Joining us from Paris is Max Turner, one of our US securities partners. And along with Max and I is Lachlan Lowe, who is head of our public company advisory team. Lachlan heads our team that is specifically designed to assist companies as they transition from IPO through to life as a public company. And in that regard, we measure the success of an IPO not just at the closing, but indeed as to how the company develops and transitions from a private into a public sphere. Before we dive in, why don't we give some key stats just to basically highlight the importance of ESG when it comes to IPOs. So, as at 2020, the US had a quarter of its assets under management in ESG-rated instruments. That's approximately $12 trillion. In over 2,000 academic studies, 70% of those showed a directly positive correlation between ESG scores and financial performances of businesses. And perhaps one last one that was announced yesterday by the UK Treasury, 70% of the UK public wants their investments to make a difference to the planet or its people. So clearly ESG matters, and it matters to IPOs in ensuring that they are done successfully. So perhaps I can turn over to you, Max. What have you been seeing in terms of IPO disclosure around ESG matters?
Thanks, Inigo. Well, we're definitely seeing a shift in how issuers approach ESG and ESG disclosure in their IPOs, and it's been surprisingly fast, actually. You only need to go back a few years, say 2017 or 2018, and for a lot of issuers in their IPO prospectus, say not a whole lot on ESG matters, other than maybe for the larger industrial groups, sort of typical information maybe related to risks or other aspects of their business that have a pretty significant environmental impact. But as far as most issuers go, not a whole lot. And then you start to see a shift around 2019, and that would coincide with when a lot of the European Union member states started transposing into local law the non-financial reporting directive, which it set out rules that apply to larger listed companies, but definitely I think changed the tone in terms of what's expected from a company in its IPO phase. I'll use France as an example because it's my home market, but also because France has distinguished itself as being particularly aggressive on this front and having transposed into local law a quite strong version of the reporting directive. And if you're an issuer hoping to IPO on Euronext Paris, you can definitely expect a lot of attention from the French financial markets regulator, the AMF, on your ESG disclosure, on the work that you put into it and the objectives that you're setting for yourself. The idea being, I think, from the AMF's perspective, is that this is going to establish a baseline for companies in terms of measuring their future performance, and it's important that they have this from the start, even in their IPO process, so that investors have a way to evaluate them. If we look even at more recently at the IPOs of the last year, we can see this shift further accelerating. Companies taking the ESG disclosure pretty seriously. It's no longer just a checking the box exercise, but it's really the source of quite a bit of attention. And most importantly, we're seeing the ESG type information migrate from, say, a dedicated chapter on corporate responsibility or governance to the actual equity story. So the marketing phase and the marketing aspects of an IPO now include some measures and aspects focused on ESG. And so in the roadshow, for example, a presentation for an IPO, you're likely to see a few slides setting out where the company is, what it thinks its strengths are in terms of its ESG positioning and what it's doing and what it hopes to do in the future in terms of reducing let's say, environmental impact or emissions or increasing diversity among its employees or board or what have you. So I think looking ahead, it's going to continue. I can even see a time when, in the not so distant future, when the ESG sections of an IPO prospectus get as much attention as we currently give, say, to the risk factors or the management's discussion of financial results, sort of showing just how much the market has changed and how much more investors are focused on this in particular. Of course, how a company who's considering an IPO wants to present ESG is going to vary from issuer to issuer, and I think certainly depending on the sector that's concerned. Industrial groups obviously are going to have different things to say than, say a retail-focused group. And actually, Inigo, maybe I'll take this moment to pass it back over to you, because I know that there have been some recent retail companies IPOing in London lately. What have they been saying in their prospectuses or in their communications on ESG?
Yeah, thanks, Max. That's true. But before I get onto that, perhaps another stat that perhaps sort of highlights to the point that you've been making. So McKinsey have estimated that by 2029, the Millennial and Gen Z population will account for 72% of the world's workforce. That's a 20% increase from where we are today. And it is undoubtedly the case that those generations are far more focused from in terms of ESG related matters. So whether they are customers, employers, investors, it's all going to be part of the system, if you will, which will drive how IPOs are sort of looked at by investors and indeed those people undertaking them. But going back to your point around retail investors, look, for sure there's been a few on the London market this year, and you can clearly see from the disclosure that a lot is made as to how these businesses are not just obtaining their raw materials from sustainable sources to minimize environmental impact, be it cotton or leather for clothes or shoes, or be it wood for furniture. But it's also a lot is being made around the disclosure in terms of supply chains, and in particular how and what policies the companies have in respect of controlling and really ensuring that those suppliers to these businesses are really focused on the ESG matters. And in terms of the retail sector, clearly the workforce and where particular products and clothes are being manufactured and the conditions under which those are being manufactured are absolutely key. And there have been historically a few instances of some high-profile cases of actually listed companies which have fallen perhaps a little short on that side of things, and so therefore it is an industry where this is being focused at. But I guess for me the key lesson learned on all of this is that if you are as an issuer looking and thinking about this at the time of your IPO, you are too late. You really have to be thinking of ensuring that these policies are embedded into the institution well in advance of your IPO, such that as and when you transition and you start preparation for your IPO, you're able to engage with investors and you're able to explain to them how your policies operate and how they've been able to actually drive good behavior. So it really is a case of, I think, of planning and ensuring that you're able to then positively discuss matters as opposed to sort of being reactive in nature. But I guess, Max, we've been talking a little bit about the disclosure and perhaps the more positive side, if you will, of how ESG is sort of coming to the fore from a disclosure perspective. But you touched upon a little bit on risk factors. Perhaps I can pass it to you to talk about what you're seeing on that side of things as well.
Sure. Thanks, Inigo. It's a really good question because, as you said, the more that companies want to say about what they're doing in the ESG space, the more that risks are likely to follow. Though it seems to be lagging a bit, I would say we're still seeing the sort of classic risk factors that are really focused on environmental impact, for example. Again, for companies who have factories or otherwise may be quite exposed to environmental regulations. We're seeing risk factors about the increased cost of compliance with these regulations. And we're also seeing, as you were mentioning the supply chain, we're definitely seeing mentions in risk factors relating to suppliers or supply chains, concerns around the actions of those suppliers and whether they are coherent with the issuer's ESG positioning or pledges in that respect. But I think this is probably going to still evolve quite a bit going forward. I can imagine we're going to see more ESG focused risks, maybe more broadly focused on ESG generally. For example, a failure to meet the targets that the issuer set out for itself, or failure to live up to its strategy. Those clearly carry potential reputational risks in addition to risks of non-compliance with applicable reporting directives or laws in local jurisdictions. So I think this is only going to go up. And one of the reasons I think that is there's this question, an open question in terms of potential liability, and in particular disclosure liability. Now, this is something as a U.S. lawyer that I'm quite focused on, and a lot of European issuers, when they're doing their IPOs or planning their IPOs, they usually do include a U.S. placement to investors using, for example, Rule 144A. But that also brings with it potential risks, exposure to liability in the U.S. On the basis of bad disclosure, so faulty disclosure, class actions relying on the famous Rule 10b-5. And so the more that you say about what you're doing today or what you're planning to do in the future, the more you are exposed if, for whatever reason, what you've described about your current activities is inaccurate or misleading, or you're way off the mark in terms of meeting your objectives. But I think the question is whether those claims that you had, let's say, bad disclosure in terms of ESG are actionable. I think a clear question is whether those statements or misstatements or omissions would be material, given that the essence of a 10b-5 claim, at least, is that there was a material misstatement or a material omission. Now, what is material? Classically, we looked at that as what would a reasonable investor consider important in making an investment decision. Now, that's usually tied to the financial results. So if there was a risk that the issuer failed to disclose, and that risk directly impacted their ability to generate revenue or their net income, clearly there is a basis there for an investor to make a claim. But when we're talking about something like ESG, and maybe it's not so clear cut, maybe the issuer failed to be as good a citizen as it hoped to be, but its business is doing fine. Is there a basis for a claim there? That's not certain. I think in the U.S., the view probably is no, or at least it would be challenging. I imagine in Europe, though, the attitude is different. Europe seems to have really embraced this idea of stakeholders in companies that goes beyond, investors or the financial interests. There's also the communities at large and those impacted directly or indirectly by a company's, actions. So, I think that is definitely a space to watch, and I think we're going to see risk factors evolve as a result, as companies, start to face that kind of liability, or at least concerns about it. I don't know, Inigo, if that's a very U.S. view that I'm giving. I'm not sure if as a the European perspective is the same, or if you have other thoughts on that.
No, look, I think you're right, and I think one of the key challenges as the ESG debate unfolds is that I think investors and public at large is asking for more data in terms of holding companies to account as to what exactly are they complying with from an ESG perspective. It isn't just good enough anymore to have good intentions, if you will, but actually investors are demanding to see how some hard facts around this stuff, and that will undoubtedly bring with it questions from a liability perspective, from a comfort perspective, as to how do you get comfort that what is being alleged to have been done to have been the case. But perhaps, Lachlan, I'll bring you in now, if I may, in the sense that a lot of the legislation around ESG in the equity markets is really not actually at the IPO stage, but it's in that it's as the company becomes a listed entity, and that's where the sort of the legal regulatory framework really kicks in. So perhaps I can pass it over to you and get some thoughts on that aspect.
Absolutely, thanks, Inigo. Look, I mean, you can sort of see on the slide, hopefully, sort of my ESG wheel of factors, if you like, and for every single sort of ESG factor there, I think there's almost a whole raft of legislation attached to that. Now, obviously, there's no single overarching piece of ESG legislation, and ESG in the UK and I think most countries in Europe is really sort of a disparate array of domestic and EU derived laws, and none of them are ESG focused. The European Union has been the first mover in a lot of the global efforts to legislate on ESG. And on this slide, you can see a number of the sort of key UK pieces of legislation on that. Now, obviously, after IPOs, companies ensure that they can comply with all the regulations that they need to comply with. And I'm not convinced there's necessarily a huge shift as between pre-IPO and post-IPO. I think where the big difference comes is in relation to disclosure. Now, it's generally just more extensive, more onerous, more prescriptive post-IPO. And what we see with a lot of clients we advise sort of in that initial year after IPO is that they largely take their prospectus and sort of a lot of the disclosures in their prospectus, really use that as the base for preparing the annual report and accounts, which is really, the first, I guess, meaty public document after the IPO. So I thought I'd just highlight some of the prescribed disclosures in relation to ESG in annual reports and accounts. So most have to have a strategic report, and that has to set out the impact of the business on the environment, and it has a number of disclosures around companies' employees, social, community, and human rights issues. And then, as Max mentioned, you've also got, particularly for traded companies and public interest entities, the disclosures required as a result of the non-financial information directive. Now, that can be pretty involved because you've got to set out a description of the company's business model. You've got to actually set out the policies that are pursued in relation to ESG, and the extent you've done any diligence processes or implemented diligence processes in relation to those. Also, a point Max touched on, you've got to include a description of principal risks relating to ESG matters. And then on top of that, to the extent that you sort of don't pursue any policies in relation to these ESG matters, you actually have to provide a reasoned explanation for not doing so. So I guess the point there is, it's not just enough not to disclose if you don't have something. You actually have to be able to explain. And again, what we're seeing now is when auditors are undertaking their technical review of the annual report and accounts, they're actually flagging, well, really, do you not think you should have some sort of ESG risk in here? We've seen, some traditional industries, perhaps your tech industries, which haven't traditionally focused on ESG, in particularly perhaps fast growth tech companies. They're really having to very quickly get in place and start to roll out ESG programs so that they can meet their disclosure requirements. And then similarly, there's very prescribed requirements around, your scope 1, your scope 2 greenhouse gas emissions, what your energy consumption is. And then obviously on top of that, it's not just all about the E aspect, you've also got the G and the governance side of things. Now, again, in the UK, the corporate governance code is very prescriptive, but it is on very much on a comply or explain basis. But the proxy advisors, when it comes to that first AGM after listing, they're very alert to governance arrangements that are in place in the company, and will, it's not fine. You might have ticked the box, you've explained why you're not complying, but that's really not good enough. And you need to be able to navigate, what is acceptable to explain and what isn't. So that's sort of a very quick whistle-stop tour, I guess, of some of the key ESG disclosure requirements. There's also quite a lot of noise in the UK at the moment, around the quality of what disclosure looks like. And just the other day, the Financial Times had a very good article which just noted the widespread lapses, particularly around climate risk reporting, and just really the inaccuracies. So, they did a survey of annual reports, and they'd admitted information about critical climate-related risks. And there was inconsistencies where they'd claimed something was financially material, but hadn't actually sort of addressed that in the financial statements. So I think we're very much at the stage where companies are largely finding their feet as to what they need to disclose on some of these matters. And it's just not perhaps quite as consistent yet as it needs to be. Now, on top of your mandatory disclosures, there's obviously a whole array of other ESG frameworks that are out there. Now, a company can obviously choose whether or not it follows these frameworks, and Reuters has described them as the alphabet soup, just because there's so many different acronyms. And I think the difficulty we've experienced, again, largely for companies that are pre-post IPO trying to put in place some sort of ESG policy and framework and program, is trying to meet the demand of all the different stakeholders. So different companies, different industries, different pressure groups, different stakeholders want companies to disclose against different standards. And it's very difficult for companies to navigate and work out, which standards they should be disclosing against. So on this next slide, you can see a very sort of a summary of perhaps the more popular ESG frameworks. And I think the one that's sort of perhaps most topical and most interesting at the moment is really the TCFT framework. Now, particularly from a UK perspective, historically TCFT has been an entirely voluntary framework. But now in the UK, with financial years actually starting from the beginning of this year, it's been incorporated into listing rules that companies with premium listings must state in their annual reports whether or not they've disclosed in line with the TCFT's recommendations. Now, and again, it's very similar to in the UK, the comply or explain approach to the corporate governance code. To the extent that they haven't disclosed, companies have to explain why they haven't disclosed, and then what steps they've taken to make the relevant disclosures in the future, and the associated timeframes. So we're really sort of, companies are getting their sort of feet held to the fire with regards to disclosing on, against the TCFT framework. And similarly to, the point around corporate governance code, your proxy advisors, your ISSs, your Glass Lewis's of this world are going to be focusing on these disclosures. Now, as of yet, it's perhaps too early to say what good disclosure looks like, but, a significant number of companies have already voluntarily disclosed against the TCFT framework. So that, there is a body of, reporting out there to be able to see, I guess, what good looks like. Part of the problem with all these sort of standards is there's sort of nuances as to their implementation between jurisdictions. So what we're, most likely we're going to see discrepancies as to how the disclosure requirements are implemented. And I think where that's sometimes problematic is if you've got a dual listed entity, for example, it becomes quite inefficient in terms of working out, what disclosure needs to look like. So this next slide just has a very quick overview of what the TCFT's recommendations are, and this is taken from the TCFT Good Practice Handbook. And I think really the key point to sort of flag here is that companies have to disclose the metrics used to assess climate-related risks. They have to gather the data. Targets have to be set. So, I think the point here is, as Inigo sort of mentioned, it's not just enough to get to IPO, be sitting in front, drafting your prospectus and trying to sort of cobble together disclosures and targets. This has to be, a full sort of program of, that's outlined and developed through a company and through an organization. And then if all of that weren't enough, on top of choosing your ESG framework, you've actually got to implement it. Now, when ESG sort of come to some of the boards I've been involved with, the focus has always been on ratings. So, it's very easy for a director to see a ratings report, see the rank of their company and go, what's going on here? Why are we at this level? And then the problem is that then, gets all the wheels in motion and everybody's going, oh, how do we increase our rankings on this particular report? And the problem with that approach is it's sort of the tail wagging the dog, because there's 600 different rating agencies at least, all with very different disclosure requirements, different criterias. I've put on the slide there sort of perhaps the most popular ones. But, you can't design your ESG strategy, I don't think, around achieving a particular good rating. It needs to be flipped around the other way. Focus on what you should be reporting, set your ESG goals, and then you'd hope that a good rating would follow from that. So I think, as a public company advisory function, we obviously see lots of different companies in very different stages of development on the ESG side of things. And that's pre-IPO, post-IPO as well. And I've sort of just set out on this slide, a few areas where I think there's sometimes pitfalls and where some companies we've advised have sort of got themselves into a little bit of trouble. I think the first one is around, what commitments do you make? IR teams, PR teams, love a good headline, love a good, we're carbon neutral or we're net zero carbon. But, that can start to unravel when you have to constantly repeat that. You have to disclose that. You have to be able to stand behind that. And then, as Max was saying, what happens if you can't actually achieve what you set out to achieve? Is there any, liability there? Second point is sort of that I alluded to earlier was really, design your own program. Don't, for your industry, for your company. Don't be pressured into, necessarily what other companies are doing, what other industries are doing. So I think ESG is generally very bespoke and focused to a particular, to particular companies on the company level, subject obviously to your compliance with the, relevant laws and regulations. I think the area where I've seen most problems is around the operationalizational implementation of the ESG program. And I think, Inigo and Max can, jump in here, but the biggest problem I've seen is just getting good quality data, getting accurate data, having the right resources internally to pull that data together, and getting data that can be relied on. Now, all the, for the companies that are interested in the ESG rankings, most ratings agencies use publicly available data. So that's why the prospectus, the annual report and accounts, sustainability report disclosures are actually incredibly important. And, we were advising one company who, 2 years after IPO, realized it had undisclosed its greenhouse gas emissions by 50%. Now, that's perhaps an easy enough statement or, to correct, but that then meant there was a shortfall in their carbon offsetting, which meant, they had to buy more carbon credits, etc. So, there's always knock-on consequences for, getting that initial data wrong. I think I'd also add, the importance of on one side of things, ES and G should be treated, very separately, because they're such different, entities, components in their own right. But you do need good governance around an ESG program. And again, it's just finding the right level within an organization as to where ESG should sit. What I've been seeing is largely audit committees have been taking responsibility for it, given the drive towards, linking ESG to financial performance and metrics. So, it has to be promoted at the highest levels, and you really need to get board buy-in if it's going to, if your program's going to really get off, get running. And then I think, there's a few other points on the slide there, but I think the two other ones I really would flag is the need to keep up to date. As businesses sort of move from, IPO to post-IPO, are in fast growth mode, a lot of the thresholds for which bits of legislation apply to you change. Do you suddenly become into the remit of the Modern Slavery Act? Do you need to start gender pay gap reporting? And these sort of, if it's not on anybody's radar or anybody's horizon, failure to disclose under some of these statutes can creep up on you quite quickly. You'll end up getting a letter from the government saying, why is your Modern Slavery Act statement not on your website? And these are all, they're all fixable, but should be sort of proactive on these sort of side of things rather than reactive. And then I think the last sort of thing I'd say is, know which laws apply to you or the company you're involved with. And I know that sort of is stating the obvious, but and for a UK incorporated company with a premium list on the LSE, it might be quite straightforward. But when you're starting to look at, UK incorporated company with Euronext Paris listing or in Amsterdam, it starts becoming a bit trickier. So, one thing that we sort of pull together, which clients usually find quite helpful, is a sort of continuing obligations, almost compliance manual, setting out what applies when. So I think, that's sort of the bits of advice from the queries we get, and the involvement we get from clients. Max, going to go. I don't know whether you've got anything to add or any questions that come in.
No, well, I think the key takeaway I'm deriving from that, Lachlan, is yes, as Max was highlighting, there's a lot more disclosure of late in IPO prospectuses on ESG, but actually the breadth of legislation that that kicks in, and then the ongoing obligations once you IPO is actually in a way more sophisticated. And I wonder whether actually the IPO prospectuses are yet to continue that upward trajectory in terms of disclosure on ESG related matters to much more closely align to what the company will publish, as you say, in their first annual report. So that's certainly what I'm taking away. But as you say, perhaps we turn it to questions. One that's come in here, I see, perhaps one for you, Max. You talked about 10b-5 liability in the US related to ESG. Have you seen the SEC? What have you seen in terms of the SEC's attitude towards voluntary or indeed mandatory ESG reporting?
Thanks, Inigo, and I always appreciate a U.S. question for a U.S. lawyer. That's nice. I would listen. The U.S. is clearly pretty far behind on the regulatory front compared to Europe. That's not to say that U.S. companies aren't making ESG disclosures or reporting on ESG. In fact, a lot of them are. I think I read somewhere that the vast majority of the S&P 500 makes some kind of ESG related disclosure. But I would say the quality and the extent and even where they make those disclosures really varies quite a bit. The SEC thus far has not been very present in this space, although there's a lot of growing pressure on them to do something to release new rules. And actually, we're supposed to see some proposed rulemaking on ESG disclosure come out this year. But it's probably too soon to say what kind of rules that may be. The U.S. is funny in the sense that there's quite a divide in terms of what issuers should be required to say as opposed to may choose to say. Some people may point to the fact that there is already a lot of disclosure voluntarily by issuers today as a sign that the market is taking care of things and investors are guiding issuers in terms of what information they want to see. But again, the variety and the lack of, let's say, objective standards is something that is missing in the U.S. Though even if the SEC does come out with fairly ambitious rulemaking in terms of ESG disclosure, there's no guarantee that those rules will be upheld. I'm thinking a few years ago when under the Dodd-Frank Act, the SEC was instructed to draft rules about disclosures around conflict minerals for mining companies, and that was immediately challenged, and the initial rule was actually nullified. There's a strong belief that it's unconstitutional to require speech or impose speech on people or companies. So I think whatever the U.S. does, it's going to be controversial. And it's probably going to be slower to arrive at the more, I don't know if we can say it's uniform yet in Europe, but clearly they're moving in a direction. So I think we'll have to continue to watch that space and see if there's a more global, unified approach taken inspired by the European practice or something more uniquely, laissez-faire in the U.S. So that's my take on it anyway.
Okay, great. So here is another one. Will we see a green IPO? Perhaps I'll give it a go. So what is a green IPO? I guess would be my immediate reaction. Is it just with regards to use of proceeds? Or is it to do with how the IPO itself is conducted? I asked that as a general question back, I guess. I know there was some press speculation around a potential IPO that is ongoing at the minute in the US as to whether they had put themselves out as being a green IPO in their first submission, and then I think in their subsequent submission have rode back a little bit on that claim, which I think was an interesting development. But look, we are certainly seeing, if only because we've been forced to through the pandemic, that the way we execute IPOs are certainly, in a way, perhaps not by design, but by necessity, have turned into more ecologically friendly, if only because there has been less travel. There has been much greater use of, or less use, I should say, of physical copies of prospectuses being handed out, and a much greater reliance on electronic distribution of materials, which I guess is facilitating that lower environmental impact on matters. But I don't think we've seen yet, certainly I'm not aware of having seen a pure dedicated use of proceeds for pure ESG matters yet. But, I think it's probably not long in the coming. So I suspect that will be upon us soon enough. Perhaps, and just conscious of the time, we've got one more question coming in, and Lachlan, just to be fair, we'll spread it out. So the last one for you. What impact do you think the pandemic has had on ESG in terms of companies and their reporting of ESG related matters?
Look, interesting question. I mean, I think the human impact, I guess, of the crisis it has been immense, and I think businesses have really had to respond to that, obviously. But a lot of businesses, have really taken it as an opportunity to sort of fundamentally change the way they interact with their employees. So, for example, having work from anywhere contracts, for example, is something that we've been seeing. So, I think it's really proven as a catalyst, for a different employee engagement environment. And I think, that's the sort of information that the companies should be disclosing and talking about, and telling the market about, the changes that they've made with regards to their employees in their workforce. I think another change we're going to see is going to be obviously more regulation. I think the crisis has sort of, it's triggered a lot of government intervention, and I think that's a trend that's going to continue. So, I think they're going to use, for example, the furlough scheme, these sort of support measures that have been put in place. They can use those as levers in order to pursue their ESG policy objectives. So I certainly think we're going to see that. And I do think there's going to be, an increased acceleration towards efforts and initiatives to generally decarbonize economies. I think we all saw the pictures of the Himalayas smog-free, and I think a lot of people are, I think it's a very vivid image, and I really think it's a way of, it's a way of, driving change, to be honest. So I really think sustainability is really going to be factored in to government recovery programs. I think that's really all going to trickle down to what's expected in terms of ESG measures that companies are following, and also the disclosure standards.
I'm just going to jump in, Lachlan, because I agree with what you're saying, and I think anecdotally, maybe to add some support there, of course, all issuers, whether they're listed or are doing their IPO, are required to provide some pretty detailed disclosure on the impact of the COVID pandemic. A lot of that's on their financial results. But what's interesting is we're also seeing them take time to talk just how much they care about their employees' well-being, and I don't think that was something that we would have seen a few years ago. Whereas now that's really front and center. The importance of the workforce, the importance of the workforce's satisfaction and well-being in their jobs. It seems to be something that issuers really want to talk about.
Sure. Okay. I think we're coming up against the clock, so I think we'll call it a day there. But just to say thank you very much for all of you for dialing in and listening to the webinar. We hope it's been helpful and informative. And if you have any other questions, do please continue to send those through the platform, and we will endeavour to get back to you through email or otherwise. Thank you very much, and have a great rest of the day.
Thank you.
Thank you.
Thank you.